Watch an active Forex trading session, and you will see a constant, violent war between buyers and sellers. A standard candlestick chart documents every single one of those micro fluctuations. If you're in a strong multi-day uptrend, your screen is still going to be littered with sharp red bearish intervals. For a trader trying to hold a position, that influx of contradictory data creates visual noise. It triggers second guessing. You see a sudden red candle, your pulse jumps, and you assume the trend is breaking. To survive an active market, you don't need more data points to process. You need a way to filter out the static so you can clearly see the underlying momentum. When a trader cannot distinguish a minor pullback from a total reversal, they often abandon a high-probability position right before the market moves back in their favor. The solution to that chart noise is a Japanese technique called Heikin Ashi, which translates to average bar. This animated chart shows how it works. We start with a traditional, jagged candlestick view, and as it morphs into a Heikin Ashi chart, that chaotic mix of red and green becomes a solid, flowing sequence. Look at these two consecutive candles. In a standard chart, each block is calculated in isolation, but the Heikin Ashi formula mathematically links them. The data values from the first candle flow directly into the base calculation of the second. Because of this chain effect, the chart absorbs minor price fluctuations. Even when there is a brief downward dip in the market, the mathematical weight of the previous candle forces the second one to remain green. By altering how price is calculated across time, the trader is mathematically forced to look at the broader momentum, making it much harder to react to a sudden, isolated price panic. This diagram shows the clearest signal in the Heikin Ashi system, a continuous sequence of long green candles moving upward, explicitly lacking any bottom wicks. That missing lower wick tells us exactly what is happening under the hood. It means the buying pressure was so consistent that the period's price never dropped below its opening mathematical baseline. But trends eventually lose steam. Here, we see the previous strong sequence giving way to smaller green bodies, and notice that wicks are now emerging from both the top and the bottom. The momentum halts completely on a single doji candle. This tiny body, framed by equally long wicks on the top and bottom, shows a perfectly balanced mathematical tension between buyers and sellers. These specific anatomical changes serve as a highly accurate early warning diagnostic. They give you the logical cue to tighten your stop losses before a full market reversal wipes out your unrealized profits. There is a cost to this clarity. The exact mathematical averaging that provides high visibility of the trend inherently creates a delayed, lagging signal. This side-by-side comparison reveals the danger. On the right, we have the actual market candlestick. On the left, the Heikin Ashi candle. Notice the clear vertical gap between the Heikin Ashi close price and the actual market close price. The Heikin Ashi value is an average construct, not the real executable bid or ask price. This creates a strict rule for risk management. You cannot place stop-loss orders based on the smoothed wicks of a Heikin Ashi chart. Your stop-losses must remain tethered to actual market structure. You have to find the real swing lows on a standard price feed and place your literal orders there. High-clarity trend analysis comes at the expense of execution precision, which is why traders must separate their visual research from their literal order placement. Heikin Ashi functions best as a confirmation tool, working in tandem with other indicators to compensate for its inherent delay. This chart shows how we layer the analysis. We've added a 50-period moving average as a baseline filter. We only act on a bullish Heikin Ashi signal when those green candles cross and remain actively above the moving average curve. To verify that the smoothed green candles align with actual market strength, we then check a momentum oscillator, like the relative strength index, as our secondary confirmation. This technique provides an objective lens for viewing the present market state, stripping away the psychological friction that often leads to impulsive trading errors. You can explore FXNX's advanced charting platform to test this setup, combining Heikin Ashi with these vital secondary indicators by claiming a free demo account. Systematic trading requires filtering out market noise. When you pair mathematical averages with strict structure-based risk parameters, you build the discipline necessary to actually hold a profitable trend to the end.